Today we are going to discuss unit 13, 14 and 15. There are 3 units, and this unit is the extension of our previous discussion. Previously we were discussing evidences, the purchase, sales and cash receipts, cash payments. So this is the extension. The chapter name is Evidence, Other Assets, Liabilities and the Equities. Broadly, we will discuss the substantive testing of property, plant and equipment, that is a non-current asset, substantive testing of investments, and substantive testing of non-current debts, that is the liability, and the equity and testing of the payroll system. Now, we are very clear what is substantive testing. Substantive testing is the detailed testing of the transactions. And one term we use, that is the analytical procedures, which is to compare and make certain relations to see, like this year, last year relation of sales with the assets, like a typical ratio analysis. These are the tools which auditor generally use to see the risk assessment, test of controls. So in this chapter we are going to focus on the substantive procedure, that is a detailed testing for the property, plant and equipment, with assets, liabilities and equity. Let's start the discussion. First of all, what is property, plant and equipment? This is the non-current asset, and surely you have this asset. There will be some purchase invoices, then this will be physically placed somewhere and you have to depreciate over the year. So we have to see that whether the asset actually exists, it is workable form, then the physical fixed asset register is there in the company and supporting documents, vouchers are there. Then how the depreciation is calculated. Depreciation is accurately measured, and this is reliable estimate, and then we can use the same abbreviations that we discussed previously, the CAVE code. So first of all, we have to see the completeness, that all transactions are completed and recorded in the system. Then we can perform the analytical procedures by analyzing the total assets with the sales, total asset with the other variables, just to see the cause and effect relation for the verification. Then we can reconcile typically the subsidiary ledgers with the journal ledgers. So the individual books should be in accordance with the GL transactions. Then analyze repair and maintenance, because these are the non-current assets. So the repair part is mandatory. So if there is one asset, and it should be supported by the repair and maintenance agreements. And we can see, okay, if there is one asset, what is the repair, daily, monthly or yearly will be on that assets. First of all, you have to see the accuracy. You have the amount for specific accounts has been recorded appropriately. For that, include amount classification in the management representation letter. Valuation and allocation. The value that is given to this account is accurate. Balances are in accordance with GAAP, generally accepted accounting principles, and we should link it with the recognition, how to recognize the asset, and assets are recorded as lower of cost or the market value based in US GAAPs. In IFRS, assets are recorded at lower of cost or NRV, that is net realizable value. But in US GAAPs, we should keep the difference in mind. This is lower of cost or market value. Then we can inspect the records for the purchase. We can vouch additions and disposals, this addition in the assets and the disposal of the assets. which will supplement that this asset was bought in 2002, sold in 2009, so you can count the reference, the addition and deletions. Then you can test the depreciation, that how it is calculated. You can see the consistency, that every year straight line, same method is used. And you can see the existence assets physically exist, like we do it in the case of inventory, that we observe the stock take, we go to the location, we saw physical stocks are there. Same for the assets, we can inspect the plant additions. Then for the depreciation, we can have a cutoff, that for calculation the depreciation 31st December is the cutoff. We can see the movement of addition, deletion before and after the cutoff period in continuity, to see that there is some window dressing has been done with the financials. So cutoff period is very important. Like for a fiscal year 1st January to 31st December, the cutoff is 31st December. Now it's always recommended and it's a positive approach to see after the cutoff, that is there any significant transactions took place which reflects the previous year's transactions. So this is how the auditor can analyze in a better way. Then test the cutoffs, addition and disposal near year, and should be tested to ensure recording in the proper period. Rights and obligation, do the entity has the right, this is their asset or it's a leased asset, they put it in their accounts, and this asset is outsourced asset, they have sold it, they are using it as rentals. Like these things we have to see the rights and obligation, examine title and leases, inspect insurance policies, inspect property tax records. It will show you that property is in the ownership of whom and who is paying the tax. And occurrence is that if the transaction related to property, plant and equipment occurs, and it actually incur or not, and this is what we have to check. Classification and understandability, is the property properly classified in the proper account, and was it an asset for the company? For example, if we are a company, we make cars. So car for us is not an asset. This is a stock, we kept it to sell. So for us it's a normal sale item. It's an inventory, it's not a fixed asset, non-current asset. So this we have to see that the asset is properly classified. Then for that we should read the financial statement, because each financial statement will show you the fixed asset schedule. This schedule will have the opening assets, closing assets, then the opening depreciation, closing depreciation, and the book values of last year and this year. So it will supplement our investigations. Now, and what else you can do is you can make inquiries from the management about the disclosure and other reporting issues. Let's discuss the substantive testing of an investments. First of all, the foreign balances are included in the audit plan. What are those? Non-current items, current items, derivatives and hedges. What is non-current items? These include capital stock or other equity interest reported using the fair value or equity method, because this is an investment. Investment can be for a shorter period of time, it can be a longer period of time. So you can see the current item, non-current items, and some investments are done in the shape of financial instruments, which we discussed in BEC, that there are future transactions, there are forward transactions, there are swappings, there are hedgings, which works as a financial assets or a financial liability. So current items include trading held to maturity and available for sale security. These are, we bought it for 3 months, 2 months, that is current investment, that we have some subsidiary which is held to sale for 3 months, 6 months, we show it in the current portion. For non-current, we have long-term sort of investments. Derivatives is an unperformed contract that results in cash flow between two counterparties based on derived from the changes in some other indicator of the values. Now, you want me to explain the derivatives at this point of time, or as we have discussed in BEC, so you are clear about it? Anyways, let me revise for you. The derivatives are financial derivatives derived from any economic transaction and any activity between two parties. They have one party is a seller, the other party is the buyer. Sometimes the things does not exist when we come to an agreement. Suppose you are a farmer, I am an investor, so I will approach you before you have cultivated the crop even. So I will give you a fixed rate to buy this after 3 months, 4 months. In that case, we will create a financial derivative which is deriving from an activity, and the actual transaction will take place when the goods will be exchanged. Then it will be recorded as sales. But before that, this is a financial receivable or a payable. So it can be a financial asset or a financial liability. Hedging is a technique to offset or to save yourself from the fluctuation of the prices. These prices could be a currency prices, it can be an interest rates, it can be any commodity, it can be gold, it can be oil. For that you enter into an agreement that is called hedging. So we classify as investments if it is receivables. Now, revenue generated from investment, the auditor should obtain an understanding of the process used by the management to classify investment before determining the nature, timing and extent of the further audit procedures. These derivatives are quite complex, and we have to see first of all, with the help of financial reporting, we will analyze it into financial assets or financial liabilities. Then for the audit procedure, once we are classified, we have to check that this classification valuation is appropriately done or not.